The analysis report we're looking at today examines the really dramatic positive shift in market sentiment for Canopy Growth Corp, or CGC.
Right.
It's arguing the stock is flipping from a sell to a potential hold or even a buy. So let's get right into strengthening that flip narrative.
Yeah, the material here is solid. I mean, it's identified a real inflection point, but to make it an ironclad thesis, we need to, head off any of the remaining bear arguments.
Especially around the financials.
Exactly. Financial durability.
Okay, so let's start with the centerpiece of the fundamental case. The report really hinges on this idea that the insolvency fears are gone.
And it does that by pointing to that 98% year-over-year improvement in net loss.
Right, a huge reduction down to just 1.64 million Canadian. That number, that 98%, is really the heart of the claim that a, quote, profitability narrative is being born.
And it's a very effective number. It really grabs your attention. But the problem is, if you're an institutional investor who's been burned by this sector before, you're just conditioned to ignore the relative figures and look straight at the absolute cash.
And that's the challenge here. The report does a great job shifting the narrative away from bankruptcy, but it sort of stops short. It doesn't give you the hard, quantitative proof of how long the company can actually run at this new loss rate.
Which is what you absolutely need to justify a hold rating, right?
So what's the specific weakness we're targeting?
The weakness is putting too much weight on that relative improvement, the 98%, without stress testing the absolute number.
The 1.64 million quarterly loss.
Exactly. You have to test that against the total liquidity, which is a pretty substantial $185 million. It's the difference between, feeling safe and knowing you're safe.
That makes perfect sense. So the suggestion has to be about confronting that liquidity question head on.
We need to frame the burn rate against the cash pile. Show the runway. That's what proves the risk-reward has flipped.
If the bankruptcy narrative is dead, we need to show everyone the coroner's report.
Precisely. For an airtight case, you need a measure of safety that's just impossible to argue with.
So how do we do that? We need a metric that's powerful but not, overly academic.
I think we introduce a simple coverage metric. Let's call it the survival horizon.
Okay.
You just calculate how many quarters the current cash pile at $185 million can sustain the company at the new lower loss rate of $1.64 million.
Right, okay. And if you run those numbers, 185 divided by 1.64, you get a figure that's well over 100 quarters.
100 quarters.
Yeah, that's over 2 decades of runway at the current burn. That one number just instantly kills the entire bankruptcy argument.
It completely changes the risk profile. The psychological impact of seeing 100-plus quarters of runway is it's so much more powerful than saying, cash improved.
It lets investors stop worrying about survival and start thinking about growth.
It shifts the entire lens.
And it handles any argument that, one bad quarter could sink them. With a cushion that big, short-term volatility doesn't really matter as much.
Absolutely. And you could even show it another way. You could compare that 1.64 million loss directly against their current revenue.
To show how close they are to neutral.
Yes, you show how that gap between revenue and expenses is almost closed. It reframes the story from less bad to almost there. Just needs a small nudge in sales.
Okay, that definitely makes the bankruptcy narrative feel irrelevant. So that sets a really robust foundation for survival.
Right.
Now we have to pivot. The analysis has to justify the leap from just surviving to, the aggressive growth targets.
This is where it goes from defense to offense.
The report points out that margins have stabilized around 30%, which is great, but it also admits there are revenue challenges. We need to strengthen the bridge between today's stability and tomorrow's high growth.
Exactly. The bullish thesis basically says, quote, they just need to scale back up.
But what does that mean? The analysis doesn't really articulate the mechanism for that scaling or like a timeline. It's a bit of an article of faith right now.
It is. It jumps from cost-cutting to a revenue boom, and it skips over how hard it is to gain scale in this market. It makes the $2.72 price target feel a little disconnected from where they are today.
So the core challenge is making the case for why the market should give a growth multiple to a company that's been focused on shrinking.
The way to close that gap is to propose explicit metrics, milestones for revenue recovery that would justify that aggressive price. We have to show the company now has massive operating leverage.
Right, operating leverage. Because they've cut their fixed costs so much, every new dollar of revenue has a much bigger impact on the bottom line.
That's our roadmap. So first, we quantify that leverage. We should calculate exactly what revenue growth rate they'd need to take that 30% gross margin and hit break even.
Zero net loss.
Zero net loss.
That's a really powerful way to frame it. If you can show that, say, just a 10% sequential jump in revenue gets them to profitability. That single data point immediately justifies the momentum needed for that 272 target. It reframes the stock as a coiled spring.
And it's actionable. It gives the market a precise revenue trigger to watch for. It turns a prediction into a verifiable forecast.
So what else? How else can we make scaling back up feel more real?
We need some structural reasoning. The analysis could suggest a few specific catalysts, internal or external, that would drive that scaling.
So instead of just saying scaling up, you could mention, for instance, a new high-margin product launch that's coming.
Or potential regulatory shifts in Germany or somewhere that could unlock new revenue.
Right. Pinpoint the mechanism. That adds a ton of conviction and ties the efficiency they've achieved to actual foreseeable growth drivers.
And it makes that turnaround story of 2026 claim feel much more credible.
Okay, that covers fundamentals and growth. Now, the structure. I think the analysis report's flow could be a lot better if it synthesized the technical analysis section directly with the fundamental narrative.
I completely agree. Right now, they feel like two separate discussions, and it really weakens the impact of the technicals.
Which is a shame, because the technical evidence is really good. It details that intraday reversal, where the stock dropped to 126 and then just ripped to close at the high of the day.
140.
At 140. And it correctly interprets that as bulls just aggressively buying that dip. It calls out support at 132 and resistance at 145. It's all there.
But the weakness is that it's presented under a separate heading, technical analysis. It's not presented as the immediate validation of the fundamental story.
It disconnects the emotional part, the aggressive buying, from the logical reason for it, which is the 98% loss improvement.
The analysis should read like one synchronized event. The fundamental shift, and the market immediately confirms it with price action.
So the suggestion is to weave those technical points directly into the fundamental discussion. Show how the market action is validating the thesis in real time.
Exactly. Unify the why with the how it's happening right now.
So how do we do that? We don't want to just, move the section up.
We reframe the discussion of the dip buying. Instead of just saying it happened, you use that specific, almost violent move, that flush out at 126, to illustrate the exact moment that smart money started positioning.
So that technical action becomes the immediate, dramatic consequence of the financial news.
Yes. And then you connect the break of resistance at 145 directly to the psychological shift away from the bear case and toward filling that gap to $2. It's the physical proof of sentiment flipping.
And we could also adjust the vocabulary. Instead of just calling them key levels to watch.
We could call them points of price validation.
Or sentiment confirmation triggers.
Yes, that's it. That's a great adjustment. It explicitly links the technical structure back to the whole great re-rating story.
So the support at 132 isn't just a number anymore. It's the market's new floor. And it's anchored by the financial stability we established in the first point.
And by weaving it all together, the analysis becomes this single reinforcing loop. Fundamentals prove survival, which triggers institutional buying, which sets higher technical floors, which validates the growth targets.